In recent years, Beijing has launched a sweeping austerity drive targeting what it terms as corruption and extravagant lifestyles within the financial industry. This campaign has sent shockwaves through the country's financial circles, resulting in everything from salary cuts and bonus slashes to expulsions from the Communist Party. This led to what has been described by some as a stringent measure imposed on its financial sector. It is an intricate situation that has sparked criticism, with opponents arguing that it signifies a misguided step. However, in order to gain a deeper understanding, let us first provide a brief contextual overview. In order to understand this present-day scenario, we need to wind the clock back a bit. China's financial sector in the past has been characterized by opulence, high salaries, and a degree of excess. This has been especially true in larger cities, such as Beijing and Shanghai, where working in finance often meant a luxurious lifestyle and a hefty paycheck. The industry had its own Wolf of Wall Street image, attracting many ambitious individuals seeking fortune and success. However, 2023 marked a profound change. In stark contrast to its previous affluence, the sector began to face austerity measures and cutbacks. The government's focus veered towards mitigating extravagance and corruption, taking aim at the financial elites. This abrupt shift appears to have been spurred by a blend of economic, political, and ideological undercurrents. The trajectory of China's financial sector parallels the larger narrative of the nation's exponential economic growth and transformation. The sector has been crucial in channeling funds, managing risks, and establishing investment platforms since the market reforms of the late 20th century. China's financial landscape further evolved with its induction into the World Trade Organization in 2001, bolstering growth by increasing global integration. China's financial boom became a beacon of the nation's prosperity. Modern financial hubs epitomize this progress, with banks and financial firms mushrooming across cities like Shanghai and Beijing. These enterprises attracted the country's brightest, driven by the allure of handsome compensation and the opportunity to partake in China's economic renaissance. Nonetheless, the sector's reputation was blemished by excessive indulgence. Tales of opulent gatherings, ostentatious lifestyles, and suspect deals fueled its public image. The sector began to be perceived as an entity detached from the lives of ordinary Chinese citizens, fostering societal tension. The stark disparity between average workers and the financial elites created a dissonance that couldn't be overlooked. The affluence within the financial sector stood in harsh contrast to the struggles of many ordinary Chinese citizens who faced income inequality, a high cost of living, and job insecurity. This discrepancy extended beyond social unrest into the realm of politics. The Chinese Communist Party, anchored in socialist principles and the ideology of common prosperity, began to appear increasingly detached from the populace. In response to this growing chasm and concerns about financial stability, the Chinese government launched an austerity campaign in 2023. This crackdown marked a crucial turning point, reflecting a shift from laissez-faire principles towards greater regulation and control. The era of unrestricted growth and excess in the financial sector seemed to be waning. This transformation is emblematic of China's broader effort to recalibrate its economy and society. The government's drive reflects its commitment to bridging income inequality, advocating common prosperity, and enhancing financial risk management. While these objectives are laudable, the impact of these measures on the financial sector has ignited contentious debates within China and on the global stage. There are several principal factors underpinning China's intensified scrutiny on its financial sector, encompassing social, economic, and political dimensions. A thorough understanding of these aspects can elucidate the government's motivations and intentions. Firstly, from a social perspective, the financial sector's ostentatious wealth and luxury starkly contrasted the circumstances of ordinary Chinese citizens. This disparity bred societal resentment towards the financial elites, stirring social tensions. By implementing this crackdown, the government sought to assuage this discord and send a clear signal of its stance against excessive affluence and corruption. Secondly, on the economic front, China's financial system had been experiencing growing instability. The accelerated growth of the financial sector spurred concerns about asset bubbles, escalating debt levels, and potential systemic risks. A lack of transparency and regulation, particularly noticeable in shadow banking and peer-to-peer lending, further exacerbated these worries. Therefore, the government's intervention aimed to curb these threats and ensure the financial system's stability. Political motivations form the third pillar. The Chinese Communist Party, China's ruling entity, heavily banks on its image as the defender of the people's welfare. The financial sector's excesses were perceived as a direct assault on this image. Additionally, the industry's corruption undermined the party's legitimacy. Therefore, the crackdown allowed the party to reaffirm its commitment to the people and showcase its determination in combating corruption. President Xi Jinping's emphasis on common prosperity is another political driving force. This concept signals a transition from unchecked economic growth towards balanced and equitable development. The financial sector's wealth concentration and perceived detachment from the real economy were seen as contradictory to this vision, making the crackdown a necessary step towards actualizing common prosperity. Finally, the crackdown reflects China's evolving approach to market reforms. In the past, China favored market-oriented reforms as catalysts for growth. However, the ensuing challenges such as income inequality, financial instability, and corruption indicated the need for a balanced approach, merging market mechanisms with tighter regulation and state control. It's important to note that these motives, while explaining the government's actions, have not been universally embraced. Detractors suggest the crackdown may dampen innovation, dissuade investment, and impede economic growth. Additionally, the suddenness of the crackdown and the absence of clear regulatory guidelines have seeded uncertainty, potentially compromising the financial sector's stability and efficiency. These issues highlight the intricate challenges inherent in China's reformation of its financial sector. The repercussions of the financial sector crackdown in China have been broad and far-reaching, affecting various strata of Chinese society, its economic landscape, and even resonating globally. Here's a deeper exploration of these impacts. At the societal level, the austerity measures have led to profound transformation in the lifestyle of financial sector employees. The stringent regulations curbing lavish expenditures have necessitated considerable lifestyle shifts. High-profile executives, once epitomizing ostentatious lifestyles, and now mandated to embrace more humble appearances. While this appears to be narrowing the chasm between them and the average Chinese citizen, it is essential to recognize the potential demoralizing effect this may have on their morale and consequent job performance. At an organizational level, companies are bearing the brunt of the crackdown. The drive to cut salaries and bonuses has shaken these firms' ability to attract and retain top-tier talent. Additionally, the heightened scrutiny has obligated financial institutions to revamp their internal controls and risk management systems, escalating their operational costs. This has led some smaller companies to shutter their operations, while others have witnessed stunted growth prospects. At the macroeconomic level, the crackdown has induced significant shifts. The financial industry, previously a high-growth sector contributing substantially to China's GDP growth, is now shrouded in uncertainty. This raises questions about the Chinese economy's overall health and future growth prospects. While the crackdown aims to curtail corruption and ensure economic stability, the sudden, stringent measures have sparked concerns about the potential economic slowdown, especially during the post-pandemic recovery phase. From a global perspective, the crackdown's ripples extend beyond China. International investors with substantial investments in China's financial financial sector are now grappling with heightened uncertainty, impacting global market sentiment and introducing volatility into global financial markets. Moreover, foreign firms operating in China's financial sector are recalibrating their strategies and operations to adapt to their new regulatory environment. Finally, there's a noticeable shift in global perceptions of China's business climate. The crackdown, coupled with regulatory actions against sectors like technology and education, is reshaping the international business community's perception of China, with a growing sense of unpredictability associated with the Chinese market. This could cause foreign companies and investors to exercise increased caution when considering investments or expansion in China. The criticism against the financial sector crackdown in China centers around several main points, each revealing underlying concerns about the potentially detrimental impacts of the crackdown on China's financial landscape and economic growth. One of the key criticisms is that the crackdown, while aimed at curbing excessive wealth and corruption, could be deemed overreaching. Detractors argue that the sweeping approach could penalize the innocent along with the guilty, which may lead to a fear-ridden environment discouraging hard work, innovation, and risk-taking, elements crucial to economic growth. Moreover, critics argue that the stringent austerity measures could be counterproductive. High pay packages in the financial sector are often seen as compensating for the high-stress and high-stakes nature of the work. By substantially curtailing these incentives, critics warn that it might prompt an exodus of skilled professionals from the sector, resulting in a brain drain. This could, in turn, impede the development of the financial sector and limit its contribution to China's economic growth. Some even predict this could encourage a talent migration to international firms, indirectly strengthening overseas competition. Finally, the crackdown is also viewed as a manifestation of a broader shift towards economic populism, where the Chinese government appears to prioritize political and social objectives over economic ones. Critics express concern that this trend could culminate in populist policies that, while popular in the short term, might prove detrimental in the long run, potentially causing economic stagnation or even a crisis.